Hi everyone, and welcome to this evening's webinar. We can just see the numbers starting to tip up there, but we are a little after 8, so we'll crack on. Look, tonight's webinar is on prioritizing and planning your finances. So what I hope to give you is a bit of an order and a process in how you approach some of the bigger decisions in life, the bigger financial decisions. So things like clearing down debt, paying into a pension, how you organize maybe your savings and prioritize short-term savings versus long-term savings, etc. So as always, these frameworks are general. There will be certain circumstances and individual circumstances that mean that they aren't quite suitable, but I think in general, we're hoping to give you something, a starting point at least for when you're approaching these things. On the financial planning, I suppose, step by step, the first thing we would always look at is your short-term debt. Okay, and the reason for that is that it can undermine your long-term finances and your long-term planning if short-term debt is tripping you up at the very beginning. Okay, so by short-term debt, we're looking at credit cards and loans. Okay, so these loans can be personal loans, car loans, things like that. Mortgages wouldn't generally fall into it. That's more of a long-term thing that you'll pay off over 15 to 30 years. And the reason that we look at it and we want to prioritize that is it's really the most expensive form of money you will use at any point. So what I mean by that is that a loan you will generally pay 7 to 8% back on. So if you borrow 10,000 euros, it'll cost you maybe 12,000 euros to pay back, very simply. And on a credit card, that interest that you're paying back jumps considerably, and it tends to be 20% plus on credit cards that you would pay back if you leave a balance sitting there. So the first thing I would always look at here is if you have a balance sitting on your credit card. Okay, it's not that all use of credit cards are bad. That's not what I'm saying. It's that a balance sitting on your credit card is costing you a lot of money, and we want to try and avoid that, because straight away we're losing money where we want to start prioritizing savings and other things. So with a credit card balance, in particular, we want to move that to the top of the priority list. Okay, sometimes it's not uncommon to see that somebody has a balance in their savings account that could clear that credit card balance. You absolutely should prioritize clearing the balance and then paying yourself back, paying that savings account back over the coming months with what you had been putting towards interest on the credit card. Another thing that I'd see is people saving into a savings account, putting 50 euros, 100 euros, 500 euros into a savings account while only making minimum payments on the credit card. So a minimum payment on a credit card is what the credit card company wants you to make, because they then get to keep charging you the maximum amount that they can. You ideally want to get that balance cleared down. So knock the monthly savings on the head, pour your spare money into getting that credit card cleared back to zero. Okay. As I said, not all credit card use is bad. People will use credit cards and clear the balance at the end of the month, which is fine. Sometimes they'll use them for bigger ticket items with a view to clearing them over 1, 2, 3 months. That generally is fine as well. What you want to avoid is that you have large balances sitting there for 6 months, 12 months or beyond. When it comes to loans, again, there's nothing wrong with using a loan or having a personal loan or a car loan. What you want to look for, though, is, do you always have a loan? Do your loans roll in? You get 3 years through a 5-year loan, and you end up topping it back up and restarting a 5-year loan. Do you get a 5-year loan to buy a car, and then every 5 years you change your car? So ultimately you have 250 euros, 500 euros going out to a loan all the time. In those scenarios, again, we would look to see, is it possible to organize things where you prioritize getting clear of that loan, paying yourself back, using your savings instead of the loan, and paying yourself back. A very common occurrence, again, when we're working with people, is that they have both a savings balance and a loan from the same institution, or even 2 different institutions, but where they have a savings balance that's considerably larger than the loan that they own. I would always say and encourage people to try and, in that circumstance, so you have savings of 20,000 euros and you have taken out a loan of 10,000 euros. That is literally an institution paying you nothing to give you their money into a savings account. Then they pass that money to the loan department, who loan it back to you and charge you 7 to 8% a year on it. So I would always encourage someone to use their own 10,000 euros and then pay their savings back, because ultimately that will mean that you'll get that your savings balance back, probably on, say, on a 5-year loan, you'd get your savings balance back in 4 years, and then that 5th year is putting extra money into your savings account, as opposed to simply just rolling a loan on again and again and again. Is there any questions there on that? Okay, so what about using credit cards to get cash back on purchases and for safety? So on that one, what I would say is, yeah, absolutely. Look, I'm not an expert on credit card offers and all the rest of it. The concern is around balances sitting on credit cards, particularly large balances, and where you're putting 100 euros a month onto that credit card, but it's not bringing the overall balance down. It's just paying interest. Using a credit card to because there's a cashback reward or whatever, and you use it for day-to-day spending, it isn't a major concern. And yes, where you're booking certain things or you're buying things online, sometimes it is safer to use a credit card. So again, it's not that all credit cards are bad or all loans are bad. It is simply that to be aware, if you have a balance sitting on a credit card or you have a loan, you constantly have a loan, that you are living on credit, and that is a really expensive way to live. Typically, as I said, it's about 20% more expensive you pay back about 20% more. If ultimately your boss came into the office tomorrow and said you're taking a 20% pay cut, you'd sit up and listen. So if you're buying things on credit, it's making them 20% more expensive. It's not a whole heap different. The second step then is looking at your safety net. Okay, so short-term debt, we've either solved that or it's not a particular issue. So the next step is to look at your safety net. Okay, and generally what that is savings. Okay, that is putting a certain amount of savings aside as an emergency fund or a rainy day fund. Okay, so that for the bumps in life, when there's some unexpected costs and unexpected things come up, you don't have to run off to credit cards and loans and that, and a health crisis doesn't become a financial crisis. For an emergency fund, a rainy day fund, ideally you would have 3 to 6 months take-home pay in that savings fund, in that emergency fund. So that is for an individual, that's your 3 to 6 months of pay, and for a couple, obviously, it's the combined. And what that will do is you want that in an account that it's easily accessible. Okay, and what it is, it's there for as I said, the kind of unexpected moments in life. If you have to take time out of work because of an illness, or you're between jobs, when you're changing jobs, maybe the boiler goes at home, or the car blows up, you have some savings there that you can fall back on. You can get through that bump in the road, and it doesn't become a debt that now you carry through the next 3, 4, 5 years. It's simply a 3-month thing. What that will also do is it will build, what an emergency fund does is it builds resiliency into the rest of your long-term planning. So before you start, quite often people ask us about investing. They want return on their money, and they want to start investing, or they want to start increasing pension, paying down mortgages, longer-term goals. If you have a safety net in place, if you have, it will build resiliency in those things. If you are ultimately putting all your money into an investment or all your money into a pension, and there is an unexpected period where you need to get your hands on money, it's not an ideal scenario to need to be going and raiding that investment account or those pension accounts to simply meet those costs. Here as well, I would also bring in, as part of the safety net, life insurance is generally a consideration. That is generally something you need to look at when you have other people depending on your income. Okay, so life insurance will replace your income for those who are relying on it if you die. In the grand scheme of things, relative to other costs, life insurance tends not to be a huge outgoing. And if you have young children or you have elderly relatives who are relying on you to pay bills, we would always recommend that you look at about 4 times your salary in life insurance. And you put it in place until probably your youngest child is kind of in the mid-20s and hopefully becoming financially independent, at least at that stage. And again, what that is going to do is just not so much for you, but for the others that are depending on you, that again builds some resiliency and creates a safety net that you'll see out some rough times and some bad times. I think the sporting analogy is Mike Tyson saying everyone has a plan till they get punched in the face. You can have the best financial plan in the world, but if you don't have that safety net in place and life slaps you in the face, things can unravel pretty quickly. And so that's it. That second step of getting your 3 months take home pay into an emergency fund and looking at something like life insurance is always the next step that we would look at. There's another question just in there on that, and that is, does income protection fall into that category as well? It would. I suppose it depends on your circumstances. Where there's other people depending on your income, life insurance is always often one of the most affordable things you can go and put in place first. But income protection is an illness benefit, so it is something we'd look at in that realm as well. Where you are, say, a single person or someone without dependents, income protection would tend to jump to the top of the list. Your life insurance needs are not as great, but the income protection will there because your biggest financial risk is actually getting ill or getting injured and not being able to go out and earn your salary, because your salary is probably paying all your bills and putting a roof over your head. So income protection would for sure would jump to the top of the priority list there for a single individual without dependents. Okay, step 3. Once you have looked at your short-term debt and then you've put that emergency fund in place, the next thing that we would look at is short-term savings. Okay, and your short-term savings is really looking at those bigger annual bills that drop in that you either put on direct debit or, as I said, you kind of use a credit card for it or a short-term loan, etc. That might be Christmas, and it's often a big spend for people. It's your holidays, it's annual insurance bills that drop in. If once you have your safety net in place, if you're in the position to put an extra 1,500 euros to 5,000 euros, it depends on your outgoings and your expenses. But if you're in a position to put that in place, then again, that will reduce your overall costs. Usually, if you get offered an insurance premium or your car tax, for example, the price to just pay it in one lump sum versus taking on the monthly direct debit, you're usually saving yourself. They'll charge you an extra fee to do it by direct debit, and it'll cost you a little bit more. So that's always, again, a useful thing to have there. That short-term savings, it's not anything significant, but it will just allow you to get through those obvious things, birthdays, Christmases, and the big annual bills that drop in. What I will say is you can use your safety net for that. So, if you're a simple example, you earn 60,000 euros a year, so that's 5,000 euros a month, and you take home 3,500 euros, roughly, probably, in that scenario. So your emergency fund is going to be 10 to 11,000 euros a year. If the holiday that you book every year in January, you book your summer holiday and it's 800 euros flights or whatever it might be, or it's Christmas or that, dipping into your safety net, knowing that you can pay that back in the next 1 to 2 months, or maybe I'd say a maximum of 3 months. There's absolutely no harm in using your safety net for that and dipping in. What you need to be careful of if you are dipping in and out of the safety net, your emergency fund, should I say, is that you're not doing that and it takes you 6 months to pay yourself back every time. And by the time that 6 months is up, the next big bill has dropped in, because ultimately then you actually never have the 3 months net pay in there. So if you know you have the discipline that it's a short-term thing, and over the next 1 to 2 pay slips, you can pay yourself back, you can pay that emergency fund back, then for sure there's no harm in using it for some of the bigger ticket items once you have it in place. Just another question in there on where's the best place to get a return on your savings? So when we're talking about your emergency fund or your short-term savings, the main piece, the most important thing is that it's accessible. Okay, an emergency fund, you don't, if it's for an emergency, you don't know that's coming down the road. So there's no point in it being in something that you can get your hands on in a month's time or in 6 months' time. It needs to be accessible really within the next 7 days. So ultimately, my advice on your emergency fund, your rainy day fund, is that the number one thing is that it's accessible. You ultimately have to take the hit that it will be in an account that is offering you a very low rate of return, but it has to be there when you need it. And having it in an investment account or a fixed term deposit account, etc., even a 30-day notice account, which maybe has a slightly better savings rate, is not ideal for that money. Okay, you do kind of need to just take the hit on that. When we get into the next piece, which is your longer term savings, that's where you start prioritizing the return on your savings, the interest that it's earning either in a savings account or in an investment product. But for those short-term savings and the emergency fund, it's very much about accessibility over return. So the fourth step that we would look at then is long-term savings. So there is such a thing as over-saving. And what I mean by that is quite often when we're talking to people, what we see is that they have large sums of money sitting in a low interest account or even in their current account. And where it's significant lump sums sitting there and not really being used, ideally you want to allocate that and put that either, as I said, into a deposit product that's giving you a better return, or ideally even into an investment product, so that it is growing over time and it's not just sitting there essentially gathering dust. What I would say, another piece as well, I would suggest particularly around your current account, aside from the return that you get, is security and safety. I do come across people with significant sums of money in their current account, or that they only have one account, they don't really have a savings account. I would always advise that you consider setting up a separate savings account, if for no other reason, it's just to have lower balances in your current account, so that in this age we live in of scams and cards being skimmed, etc., your money is that little bit less accessible for those people who are looking to empty an account into a Bitcoin wallet or something else like that. Generally, those scams are around your card number and your debit card, or they're around getting a code off you to try and clear, as I said, clear an account into an Apple wallet or a Bitcoin wallet, and it disappears somewhere. You know how much you need in that for your day-to-day spending, but big lump sums of money should not be sitting in a current account. And then big sums of money sitting even in a savings account that's not earning a lot and isn't being used for anything, isn't being utilized for anything above your safety net, your 3 months take-home pay, you should really be considering some longer-term savings options. So on that, the best returns in terms of banks and credit unions tends to be fixed term deposit accounts. They are where you will save your money for a minimum of 12 months, 18 months, 3 years, 5 years. The best rates are ultimately the longer you leave it in. They often aren't the best rates that you can get overall, but in savings terms and dealing with the banks and the credit unions, that is generally where your best return is offered. There are also investment accounts offered by a range of different institutions, and what these aim to do is they're designed for 3 to 5 years minimum, I would suggest, and they're designed to try and get a greater return for your money over that period. They act probably much like a pension, does, in that your direct debit goes off out into your pension every month and gets invested and is there for you at the end. The difference with an investment account is that you're not getting tax relief on the way in, so there isn't rules on when you can take that money back out. But ultimately, it acts in a similar way and is often accessing the same sorts of funds. So on that, they're offered by most of the big life and pensions companies. And ultimately, the thing to stress is when people hear about investing, they get worried, and they're worried about risk and losing their money. And these sorts of long-term, there are savings products, and these long-term savings accounts, investment accounts, they are not trying to double your money overnight and take big risks. Either you're going to have no money left and they're going to turn around and say it's gone because of what you invested in, or you've become rich overnight. This is a get rich slowly program. It is about your money going in and being put into a range of funds generally that are trying to get a return over time. Okay, generally, the longer you are able to invest your money in these types of funds, the better your chances of generating return. I think I'm right in saying that over any 5-year period, the equities markets, so investment markets, have never returned a negative, and have never had a negative return. While there are individual bad years over a 5-year period plus, those markets will almost always, at least in historical terms, recover and get back past where they were before that dip or that bad year. They are look, these the investment accounts and the long-term savings. Once you have your emergency fund in place, your 3 months take-home pay, you might consider something like an investment account. Where they're really ideal is for things like people starting their first job and they want to put some money away for the long term, maybe starting to save for a house deposit, which is going to be 7 or 8 years away. But you could put 100 euros, 200, 250 euros away per month. And over a 7 or 8 year period, you are likely to be in a strong position with those savings. They're out of mind and out of sight. They're a little bit harder to get at. You can get your money back whenever you want, but it's not the same as being on an app where you'll just transfer it out of a savings account back into your current account. And the rates of return should at least be higher than in a deposit product, in a savings product with a bank or a credit union. Another thing we would see them being used for a lot is child savers. So somebody saving for their child, either in their own name to cover education costs at second level or third level, or ultimately grandparents or parents looking to gift money to a child or grandchild and avoid, or at least reduce, inheritance tax liabilities there. There's just another question in here. How long an investment term should a couple in their early 30s be looking at to get a decent rate of return or return on investment? So I think in terms of your investment return, when we're looking, we will get into the nuts and bolts of saving and investing on next week's webinar, which is 8 o'clock next Wednesday, and it's specifically on savings and investing. We'll get into the bones of it. But it does depend on your own risk appetite and how long you think something will be there for. So look, if it's something in the next 3 years, then an investment account or any sort of investment generally isn't the right thing, because you need to be investing for longer than a 3-year period, I would suggest. Look, you could put that into an investment account and have 4 really good years, and have a really nice return on that of 4 or 5% a year, or even 9 or 10% a year over that period, and be delighted and want to get your money back. But you ultimately also you could have a 4-year period and your return is lower and you want to leave it there for longer. The key often on investment is, as I mentioned, it's not somewhere where you put all your savings or all your money. It's not the first step. You need resiliency in here. You need your emergency fund in place so that if you need money because of some unforeseen circumstance, you can go to your emergency fund first rather than realizing that investment in a bad moment. So generally, your investment being the additional money and additional savings that you have. When it is that, it means that you can leave it there for longer. So in a bad moment, when markets maybe are down and your return looks poor, you can say, I'm going to leave that and use my cash savings for whatever it is that comes up. That's the real key. But look, we will get into that in more detail next week, not to dodge your question. Another one, where to start? 40 years old, no savings, short-term debt, looking to start saving for a house deposit. Should I do a mix of paying off debt plus building up deposit, or just pay off all the debt first? That's super. I would encourage you to engage with somebody and to put a plan together specifically for you. What I would say is often this is an emotional piece as much as it is a pure numbers piece. But attacking your short-term debt and really pouring all your resources into clearing that and getting the first bit of debt cleared is often a really great boost. And you visibly see that something has dropped off, you've achieved something, and you get a really nice boost and a really positive hit from doing that. And that then encourages you into the savings phase. So generally speaking, yeah, I would be looking at the short-term debt and getting that cleared down, and then taking the resource that you've been putting towards clearing that debt down and now saving it on a monthly basis. And again, if to get to your deposit, so where you have a really clear goal of something like that, and it's ultimately going to take you 3 years plus 4, 5, 6 years, you might be considering something like an investment account to try and just help you, because ultimately, if in today's world and that the price of houses are going up bit by bit every year, you do ideally want to have your savings in something that is going to go up bit by bit every year as well. So look, it's a very specific circumstance, but as I said, I would encourage you in that scenario to have a chat with somebody. So if you want to, please do get in touch. So that's step 4, and then the final piece is on retirement planning and pension planning, paying down your mortgage, long-term goals, which ultimately you tend to achieve later in life. The one caveat I'll put there is that paying into your pension shouldn't be the last step. We will cover pensions in the next few weeks as well. It would come in there probably around short-term savings in terms of starting a pension on some level, but in terms of really maximizing what you can put into a pension, it's more of something that would come towards the end of your financial planning steps. And paying down your mortgage, it's something of a national obsession, I'd say. Look, I'm not a financial advisor the world around. We're here in Ireland, but it is something that's always high on the agenda for Irish people. It's actually something I get asked about with first-time buyers at 28, 29 on our very first consultation about mortgages, and they ask about paying down your mortgage early. It's a great goal to have, but one of the caveats is that when you're paying down your mortgage and you're giving the bank that money's now gone. And so if there's bumps in the road, and that's been a significant sum of money in savings terms for you, you all of a sudden need some extra help, and you need some extra cash for something that's happened. You're not able to go back to the bank and say, can I get that overpayment on my mortgage back? It's gone. So that's why it tends to come at the end of these things, making sure that you've short-term debt sorted, you've your safety net in place, you've short-term savings, you've some of the longer-term goals that, pensions and maybe, kids' education costs and things like that. And then something like paying down your mortgage, I think, should come towards the end of that. Obviously, as I said, there are circumstances where you might pull it forward, but it's always a great goal. It will save you an awful lot of money in the long run. But I would always give it the caveat that once that money, that really has to be extra money in your life, because once it's gone back to the bank, it's gone. Retirement planning and maximizing your pension. Again, a pension is the single best savings product that you have at your disposal, because you get tax relief on the way in, the money gets invested, so it's growing, and then there's no tax on that growth as well, which is fantastic. but it's not somewhere you put all of your money, because when you put money into your pension, it's locked away until you're 60 plus. Okay, there are instances when you can access it from 50, but what you're doing is preparing for retirement with your pension. So you should absolutely, the sooner you can start a pension, generally the better, because it's reducing the burden later in life on how much you have to put in every month. But it is, there are quite a number of things ahead of it in terms of priority on that. It's just another question in there. Are there taxes on investment accounts? Yes, so there is. So an investment on an investment account, generally the gain in an investment account is taxed 40%. So it's an exit tax. That said, what I will say is, people don't think about it, but even pretty much every piece of income or return you will get is taxed. So if you have a bank paying you interest on your deposit, there is dirt tax. There is tax on that as well. So there are taxes on almost everything, with the exception of the pension, which I mentioned. So look, as I said, we will get into the meat of some of these topics in the next few weeks. But when it comes to planning and prioritizing your finances, okay, the first step is always to try and look at efficiency. So is there expensive short-term debt there that's costing you money and doesn't need to, if you can move it to the top of the priority list and get it cleared down? Okay. The second piece is about building resiliency into your finances. That's for you as an individual or you as a family. You do that by putting your safety net in place. You have 3 months, at least 3 months net pay in a savings account that's easily accessible. Getting the maximum return on that money is not your priority. It is having it there for when life slaps you in the face and the unexpected comes along. A health crisis or a crisis with your car or your house doesn't become a financial crisis. You then want to look at the things that crop up annually all the time. And if January is always a struggle for you after Christmas, then can you save a little bit more through the year to get through January with a little less stress and hardship? And then once then it's always looking at, am I over saving? And by over saving, I mean, do you have your 3 months net pay in savings, but then you have a significant amount more in your bank account or your credit union account that isn't gaining any interest, essentially, and isn't working for you? And at that point, you'd be looking at that money and putting it into something longer term, a fixed term deposit with a bank, or even better, an investment account. They're offered by all of the life and pensions companies, the largest life and pension company in Ireland. They are, as I said, get rich slowly investment schemes. This isn't about taking big risks with your money. These institutions have actually probably better credit ratings than most of our big banks do. And it is very slow and steady investing to grow your money bit by bit, so that if you're putting it aside for work on the house or for education fees or whatever it might be, those fees are going to go up bit by bit every year. Those costs are going to go up bit by bit. So the money you're setting aside needs to grow bit by bit as well. And that's what these things do. And then ultimately, if you have all that in place, if you're lucky to have ticked off all those first 4 steps, then we start looking at, are you maximizing your pension contributions? Because it's a really, really, it's a really efficient way to save and to give yourself options later in life. Okay, retirement is usually a financial decision for people. So the larger your pension, or the quicker you can get to that pension goal, the more options you have to keep working, stop working, reduce your hours, etc. Paying down your mortgage, again, it tends to be at the end of that list, because cash is king, and giving your cash over to the bank, it's gone. Putting your money into savings accounts or investment accounts means that you still maintain control over it, and you do have it if you need to change course or things change, your circumstances change. So if there's any more questions, let me just have a quick look. Please do send them in to us there. So as I mentioned, we have this is the first in a series of webinars we're doing over the next few evenings, next few Wednesdays. Next week, we'll be focusing on saving and investing. So that will be getting into the bones of where are the best places to have your money, how you allocate your savings to different things, to short-term, long-term, to investing, to pensions, etc. And we'll get into that at 8 o'clock next Wednesday, back on the YouTube channel here. If you're new to us, please do give us a follow on Instagram, LinkedIn, or YouTube here. We'll be pushing out plenty of content over the next few months. And if anything resonated with you tonight and you feel like you are facing one of these decisions and you're struggling with it or you're uncomfortable with it, please reach out and drop us an email or get in touch. And always happy to try. And quite often these things can be solved, and you can get a bit of peace of mind with a 10-minute conversation and get moving in the right direction. So we're always happy to give people any time if they need it. So, okay, I think that's it. There doesn't appear to be any more questions. So look, thanks for tuning in, and we'll see you next week.